Buying your first home in Ontario can feel overwhelming. Credit scores, down payments, mortgage rates, where do you even begin? Don't worry, in this video, we'll break it down into 5 simple steps to get you from planning to holding the keys to your home. Stick around because at the end, I'll share some insightful tips that could save you thousands of dollars on your home purchase. So let's dive in. Alright, the first step, check your financial health. The first step before you even start house hunting, you need to know where you stand financially. This will help prevent many heartburns. What does that mean, you ask? Basically, building and maintaining your credit score. Ideally 680 or higher for the best rates. The higher the credit score, the lower your interest rate, meaning big savings over time. 2. Ensuring stable income. At least 3 months bank statements reflecting payroll deposit from an organization. And 3. Saving for a down payment. For smooth transaction, it's helpful to have it in your various accounts for at least 90 days. The second step is to review your debt status or your debt ratios. There are two main debt ratios that determine the eligibility for a mortgage. The first one is called the GDS, or the gross debt service ratio. It is a measure of housing costs versus a borrower's gross income. This ratio tells lenders how much of a homebuyer's gross income goes towards housing costs. The GDS ratio helps determine how much a home a buyer can afford when qualifying them for a mortgage loan. Most lenders want this ratio to be under 39%. TDS, the total debt service ratio, on the other hand, represents the percentage of a home buyer's monthly gross income that goes towards servicing all debts. That includes debts like car payments, student loans, credit cards, and any other debt that the borrower may be holding. TDS is calculated by dividing a person's gross monthly income by all the other debt payments that they have in a month. Lenders prefer borrowers under 44%. The higher the debt service ratios, the less attractive an individual is to the lender. One can try to get rid of these smaller debts like credit card and car payments to improve their ratios. The third step in the process is to organize and collate all your documents. Here's how you can prepare for this step. 1. Have your ID, resident status, and socials handy. 2. Collate proof of stable income. They can be pay stubs for salaried professionals or tax returns for self-employed ones. 3. Get the employment or verification letters from your employer. 4. Prepare proof of down payment. These can be satisfied by bank statements and letter of support. And finally, 5. Don't forget to gather all debt information and statements. Things like car payments, student loans, line of credit, they have a huge impact on your eligibility. This takes us to step 4, and perhaps the most important one. Get pre-approved and know your budget. Before you start falling in love with homes out of your budget, get pre-approved. It gives you a clear idea for the buying price and shows sellers that you are serious. You'll need the documents that we discussed before, along with an employment verification and credit bureau check. Your lender will review your finances and tell you the maximum mortgage amount you qualify for. This saves you time by making you focus on homes within your budget and shows sellers that your offers are strong and financially viable. With pre-approvals, you also get an added benefit of locking in an interest rate for up to 120 days, which can be a huge advantage. And finally, the last step, finalizing your mortgage application. Once you've identified your dream home, start the process to finalize your mortgage. You'll need to submit all the documents we discussed in the pre-approval step. You then review the mortgage terms and rate and wait for the lender to come back with the commitment. At this time, the lender may also request a home appraisal before finalizing the loan. Before we wrap up, don't forget to take advantage of first-time homebuyer incentives. First one among them is the first home savings account. This helps saving for the down payment and the amount invested is tax deductible. Second, the home buyers plan, using which first-time homebuyers can borrow up to $60,000 from their respective RRSPs. If you're applying with a spouse, you can both do $60,000 each. That is a total of $120,000. And finally, the land transfer tax rebate, where you can get up to $4,000 off your closing costs. And that's it. 5 simple steps to getting your first mortgage in Ontario. If this video helped, smash that like button, subscribe, and drop any questions in the comment below. Until next time, happy house hunting.